Good morning. Welcome to the Post-Monetary Policy Committee press conference at the Central Bank of Kenya. Today is the 26th of June 2020. The Monetary Policy Committee held its meeting yesterday and issued its press release, which we believe you have been able to see and read. So today we'll do it as we usually do, which is the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge, will be making a statement. Once he's done making the statement, we'll take questions which he will be able to answer. And we ask that you put those questions via the method that we've sent out to you on email, on social media and other platforms, which is Slido, that's S-L-I-D-O. The meeting identity is MPC26. That is #MPC26. And just as a reminder, when we come to the questions and answer, is that you will need to identify yourself by name and media house or institution, and then we are able to take those questions and put them to the governor. But for now, I want to welcome the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge, to make his statement. Governor.
Thank you, Wallace. Good morning, colleagues, wherever you are. Yes, this is the post-MPC meeting briefing, and we welcome you in the various channels that you are connecting. So yesterday the MPC met, and this is the third in the series of the monthly meetings, April, May, and June, in the context of the COVID-19 pandemic. As always, the MPC examined all the significant developments and data that has actually come into, has been produced since the last meeting, and then assessed the appropriateness of the policies that are in place. So, as we always do, we'll begin with the first element, which was the global economic outlook. And this has worsened since the last time the MPC met. And as you know, just the day before, on the 24th, the IMF issued its update on the world economic outlook. And the global growth in those projections, or the global growth is projected at minus 4.9% in 2020. This is unprecedented. That's a large dip. And it is about 2% lower than the previous projections, that is the April projection. So within 3 short months, less than 3 months, the revision has been substantial and indeed a much worse outlook for the global economy. I'll not dwell on the details of that. I'm sure you have already looked at them in various ways and sliced and diced them. But suffices to say that the advanced economy will sink by a record minus 8%. The US will contract by an estimated 8%. And the euro area will also contract by an estimated 10.2%. These are large numbers. These are huge numbers. And of course, the emerging markets, which have generally been aligned with the advanced economies, in a sense coupled with them, they will be declining, contracting by 3%. China in particular will be growing at 1%, so positive number, 1%, which obviously is a far cry from the large numbers that approach 10% that we have been accustomed to seeing from China. Sub-Saharan Africa will contract by minus 3.2, and I think I'll leave the other numbers for you to look for them in the relevant places. Interestingly, the world trade volume is estimated to contract by almost 12%. So this is amazing in terms of the magnitude and the contraction of world trade. So that said, it is clear that the world economy is, we are in completely uncharted waters. And the question is, what is the impact of all those developments on the Kenyan economy? Here I would say that there are certain differentiating factors for the Kenyan economy, and which we have generally called our sources of resilience. And in effect, if you have looked at if you have studied the Kenyan economy, you'll see that we do not always follow the rest of the world in terms of if there's a dip. There are other factors that, in a sense, stabilizes. And I want to mention those. Really, bottom line is that we are highly diversified. We are highly diversified economy, first in terms of trading partners. And as we have said before, about 20% of our trade is with our regional East African community partners. And about 40% of our trade is with the rest of the sub-Saharan Africa, or rather sub-Saharan Africa. So you can see we are more local or regional than maybe countries that are directed or have a very strong link with one large or small trading partner, China, US, UK, etc. Also, we are highly diversified on our products. So, for instance, we are not primary exporters, oil, metals, and things like that. Rather, we export a whole range of items, tea, horticultures. Of course, not just merchandise exports. We also have services exports, and tourism is a big one, but also other forms of service exports, such as insurance and things like that for transportation and other such things. We are also highly diversified in terms of our sectors. Agriculture obviously is significant, but also there's a lot of diversification if you think of the sectors in the GDP, or rather production sectors. We are quite diversified. But I think also, if you think, we also have a strong domestic consumption component. So in a sense, we are not just highly dependent on export. And in some sense, this has helped maintain our projections of GDP, even as the rest of the economy has sagged much more as indicated in the projections. So I want to mention a few things now. In general terms about our economy, now coming to the domestic economy, and in general terms, all indicators are that we had a big dip in April. So the economy, in a sense, slowed down in April. And I think this aligns with what you as viewers, as commentators, would have seen. That is when we went into lockdown in our own way, or the partial lockdown, restricted or cessation of movements and all that, the curfews and things like that, which were introduced in March, but we got the full brunt of them in the month of April. But by all indications, actually, May, the economy is bouncing back in May. And I want to make those points and illustrate it as just now. So, for instance, in agriculture is showing very strong performance at this point in the crop cycle. So, for instance, in terms of tea, we have had very high deliveries and exports as well. So, in terms of the tea production, it has almost doubled in April relative to April last year. So, for instance, tea production was 49.6 or 49,656 metric tons in April, relative to 26,131 metric tons in April 2019. So it reflects very favorable weather and obviously relatively stable prices. I'll talk about the exports in a minute, but I think the point here is that you can already see production is at a much higher level, increased by 90% just that month. Now, the other things we can talk about, the volume of exports actually, it has averaged in the period to the second week of June. The volume of tea exported so far in 2020 has averaged 11,000 tons, 11,000 tons per week, which is an increase from 9,000 tons per week on average for the same period in 2019. So you can see tea has has actually been on the upswing during this period. Of course, the average price of tea was around $1.99 per kilo so far in 2020, compared to $2.08 per kilo in 2019. I wanted to give you some specific detailed numbers, but there are other numbers that I will touch on as we move on. Milk deliveries, for instance, we are still talking agriculture. These were down in January, February, and are now very strong were very strong in the months of March and April. They grew respectively at 6% and 18.4%. Those are milk deliveries. Horticultures, I'll talk a bit more about them when I discuss exports. Maize and wheat. This, you know that in the various places in the regions that are maize growing, for instance, and wheat growing, maize is sort of at the tassel stage. There are some that are knee-high, but most of them are at the tassel stage, and they look good in terms of expectations of production. So in a sense, if this continues, we may get a very good crop, one of the better crops in recent years. But of course, it is only on the basis of where we are this crop cycle, in the crop cycle. So I don't want to continue with more of those numbers, but we have them. But I just wanted to give you a sense that the details of the leading indicators that we looked at actually are showing that there is a reversal or a strengthening from April from the month of May going forward. So May and so far in June. I want to move on now to the external sector. But I think before doing that, I would say that we expect we'll make revisions on our GDP numbers in the next couple of weeks. Obviously, we expected we would want to include the new outlook, the global outlook, but also we expect to see the first prints or the first numbers of 2020 Q1, the first quarter Q1, and we expect to see those next week. The National Bureau of Statistics should be issuing those, but the leading indicators actually that we have looked at for the month of, for the first quarter, show a pretty strong first quarter. And again, as I say, April seemed to be, was weak, but the indicators in May and so far in June are actually quite positive. We switch now to exports and more generally the external sector, the balance of payments. And in general terms, the balance of payments have improved relative to where we were, or at least the outlook on the balance of payments has improved relative to where we were about a month ago, the outlook that we had envisaged about a month ago. For instance, exports of goods improved by 4% in the period January through May, so including even the deep month, relative to a similar period in 2019. And again, this was driven mainly by tea, horticultures, re-exports, and etc. I've talked about the value, or rather the exports of tea, of which the value increased by 15.2% in May relative to May the previous year. And again, as I said, reflecting increased production and obviously limited disruptions in terms of the export process. In terms of horticultures, in May, the volume of horticulture increased by 33% and to 42.3 million metric tons compared to May of 2019. Now, this is driven by exports of fresh vegetables, fruits, nuts, and obviously flowers, which rose by significant numbers. Flowers rose, for instance, by 12.4%. And reflecting really demand from the key markets as those markets reopen and people go back to a more normal sort of lifestyle, and of course also reflects adequate cargo space and the measures that have been put in place locally by the government to maintain these cargo flights during this period. The value of horticultures in general, exports increased by 22.8% in May to US $75.3 million compared to May last year. Earnings of flowers, as I said, also rose appropriately. So this is significant, but maybe to mention a few things about the flower industry. In June, we have numbers obviously in the second week of June. The latest information we have is that the orders are almost at normal levels. So they've come up, they've come up to about 85 to 95% of where they would be. And this improvement, of course, reflects several factors. One is, of course, the increase in demand in the global markets, and also the expiry of various supply restrictions, which we mentioned last time, and the adequate cargo space. And even though we expect that the third quarter is usually a slow season for flower exports, the industry is expecting better performance than 2020. So on the whole, the numbers in terms of those key exports are positive. I want to say a few things then about, let's say, on the import side, the numbers remain subdued, so aligned to the projections that we discussed with you last time. But the price of oil has come up again. It has rebounded to around $43 per barrel. Now, this is still way below the $71.9 per barrel that we saw at the beginning of 2020. So, and again, the expectation is that the prices will remain low. But definitely $43 per barrel, though higher than where it was, say, $30 a barrel recently, is still significantly low relative to what we were saying last year. On remittances, you do recall that we were expecting a decline. Actually, we had projected a decline on an annual basis in 2020 of about 12.7% in value terms, so in US dollar terms. But actually, so far, there was a dip in April, which we mentioned to you last time. It dipped. The remittances that we were receiving dipped to $208 million. But actually, it has recovered in May to $258 million. So the decline really, or rather the increase, well, the decline in April was really pronounced, particularly because of significant declines in remittances from South Africa. Actually, that was down to $5.7 million US. Of course, that reflected the lockdown that was in South Africa. But that has now rebounded, and in the month of May, we had remittances from South Africa amounted to 15.2 million US dollars. And there was also an increase of remittances from the US. So this, of course, reflects the more relaxed, let's say more normal, or a return to normalcy in those economies. But another element is the channels that we are using. You can imagine that what has also happened is that there has been an increase actually over the last 1 year. You can now send money directly to a specific fund, that is your family, wherever they are, from the US, from South Africa. And that, obviously, that channel has been quite expeditious, or has been quite useful during this period. Bottom line, we have not revised the balance of payments. We want to obviously first revise the GDP, but bottom line is that we are maintaining the current account projection of 5.8, a deficit of 5.8 in 2020. But one could say that actually the points I've mentioned show that there is some sort of upside risk, meaning things will probably be a little better on exports, or for that matter on remittances, etc. But we will wait to make the projections, to revise the projections when we have a bit more data. Moving on, I now want to say a few things about the banking sector, the financial sector more generally. During this COVID period, the objective has been protecting the balance sheet, really, of every institution. And I would say that this applies not just to the banks, but it applies to all institutions across the board. Now, this is protecting your tangible and intangible balance sheet, if you may. So, for instance, on the intangible side, this relates to people. So banks, for instance, have been applying the pandemic protocol and guidelines that we gave them, guidance that we gave them during this period, and have been working with us to ensure that the risk towards people, and indeed also in terms of their operations, are minimized. So this means, for instance, being very careful with, specifically, I'll leave it there, with regard to the front-facing staff, that is staff in tellers and etc., how cash is handled, and also separation of teams, which ensures that there will be continuity, and other things like that. We have had to close some branches when indeed there had been some, let's say, some staff members had been, let's say, contacted because they have been in contact with somebody who had tested positive for COVID-19, and so we have moved or the banks have moved aggressively to close that branch, clean it, and then reopen it once all those medical, or should you say, health protocols have been observed. So that is important because the protecting the people is really the #1 priority in all this. But at the same time, as we have moved ahead to protect the people, the business practices have also changed. So, for instance, there has been more business is being conducted outside the banking hall. And I'll quote a few numbers here. So, for instance, before the crisis, that is for, say, January to March of this year, 88% of transactions, that is bank transactions, were being conducted outside branches. It was 88% of transactions by number and 50% of those transactions by value, they were being conducted outside branches. Now, in the period after we've gone, I mean, let's call it the pandemic period, so April, May, 94% of transactions are now being conducted outside. So it's gone up from 88 to 94% outside branches. This is significant. And also it is important to note that one of those channels is the mobile phone. So before the pandemic period, 44.4% of transactions were being conducted on mobile phones. This, again, is banking transactions. But during the pandemic period, 61% of transactions are being conducted on the mobile phone. So you can already see that there is significant movement towards digitizing, or digitization, as it were. Maybe that's not the correct word technically, but movement towards transactions on the mobile phone, or let's say outside the branch, outside the branches. Now, this is significant for us, and one could argue that if there are other countries are moving to where we are, so we as Kenya, with the rails that we have, we should really take advantage of the rails. And in this case, it really means taking greater advantage of the let's say, the infrastructure that we have. And the infrastructure is there. It just requires encouragement, and you'll see a lot more transactions moving that way, as we have already begun to see. Within 2 months, this is a significant movement. Restructuring of loans. This was also a significant development, as we mentioned. So personal loans, for instance, it was mentioned in the press release, about 199 billion Kenya shillings worth of personal loans, which is about 25% of total personal loans. Total personal loans are 795.2 billion. So those have been restructured. So 25% of personal loans have been restructured. And again, the restructuring has been, the borrower has engaged the bank, or the bank and the borrower have engaged in a conversation and understood how the borrower, how the situation of the borrower, and then sort of put together a plan or an arrangement or whatever it is. It could be a sort of a cessation of payments, or for a period of time. It could be interest, it could be principal, it could be an extension of 3 months, 6 months, a year. That is being done in the context of those conversations, with the banks. Loans in general, 679.6 billion Kenya shillings worth of loans have been restructured since we started. That's 23.4%. So again, about a quarter of the loans in that short period have been restructured. The overall loan book is about 2.9 trillion. So 23.4% have been restructured. At the same time, the liquidity that was released with the lowering of the CRR was 35.2 billion. 30.85 billion of that has already been used. And again, it's targeted to the specific loans that relate to that have been affected by the pandemic. So this is really, this was assessed by the MPC as sort of the development that actually they had in mind when all these changes were done, a couple of months ago. And in a sense, they welcomed the implementation and the outcomes that are already there. In terms of the details of loans and all that, they are not different in character from what we mentioned last time. So I'll not go back to them, but I just want to insist that yes, they cut across all sectors, they cut across all types of borrowers, and yeah, and so the point here is that again to accelerate, if borrowers would want to have a conversation with their bankers, well, they should go then to their bankers and have that conversation with them. Before I finish then, I would want to mention, so one other item which relates to the, sorry, where is it? Let's see. Yeah. So the other development, recent development in this was the review of emergency measures to facilitate the mobile money transactions. If you recall, this was put in place very early on, March 16th, and the whole point here was to encourage the use of mobile money transactions instead of cash. And this is related to the issue of reducing that risk. And this is why these measures were put in place, these emergency measures. And at the same time, in reviewing these measures, the central bank reviewed all of them and decided on the efficacy of maintaining the limits that had been put in place on March 16th. And as you will recall, this relates to, for instance, the transaction limit, which was increased to 150,000 Kenya shillings. The daily limit for mobile money transactions increased to 300,000. The mobile money wallet limit increased to 300,000 as well. And of course, the elimination of the mobile money monthly total limit for mobile money, which we eliminated, and then increased, of course, that was already the transaction limit increased to 150. So that was put in place, and again, the central bank assessed not just from the customer perspective, but really more also particularly from an AML/CFT consideration. And in any event, so those measures were put in place, and I think they have been quite efficacious. And then, of course, the emergency measures that had also been put in place at the same time, and this relate to the elimination of charges on mobile transactions up to 1,000 Kenya shillings, and of course extending that no charges also in the transactions between payment service providers and commercial banks, so the transfers between mobile money and bank accounts, also that was extended, and the tariff for the 70,000, the band that above 70,000 Kenya shillings, that also will remain in place through the end of the year. Again, this is focused on the crisis, on the pandemic, and the point here again is it is clear that it has been efficacious, and it's interesting that a lot of transactions do take place. Surprise, surprise to some of us, transactions do take place below 500 shillings and 1,000 shillings. So I think it is important to appreciate that the actual, our people do have transactions at those levels, and it matters to them in terms of cost, in terms of safety, etc. So that was the background to the MPC meeting. And as was mentioned, you did see the press release, and the MPC did look also at other factors, including the fiscal measures that have been put in place, and looked at this favorably in terms of the stance of the fiscal policy, and decided to wait to see all these policies continue to produce their effect, and particularly the fiscal measures that will begin or will be put in place from July 1. So I'll stop there and take your questions.
Okay, thank you, Governor. That was Governor Patrick Njoroge. In terms of giving the statement post the MPC, or the Monetary Policy Committee meeting that happened yesterday. So as we usually do, we shall take a number of questions which will be answered by the Governor. And just by way of reminder is that you should please put your questions through on Slido, S-L-I-D-O. If you just search for that on the internet, you'll be able to get through. You will be asked for a meeting ID, and the meeting ID is hashtag MPC26, MPC26. So to begin, Governor, in terms of the questions, the first set of questions, Steve Mbogo from the Financial Day asks, what additional measures does CBK plan to take to reduce the cost of credit to the private sector? What additional measures does CBK plan to take to reduce the cost of credit to the private sector? That's Steve Mbogo of Financial Day. Second question is from Antoinetta Rossi of the Financial Times. The question here is regarding digital lenders in Kenya who use debt collection agencies. Who does the responsibility sit with to ensure ethical and professional debt collection? That's from Antoinetta Rossi of the Financial Times. Third question is from Kefa Moirore of Radio Citizen. I know there is no crystal ball, Kefa says, but from the MPC statement, I infer that CBK sees Kenya has been through its worst from the pandemic economically. Is this the case? That is from Kefa Moirore. And the last one in this batch is from Johnston Olaturana, who is a principal lead at QL and Corporate Communications. Government of Kenya, GOK, is borrowing from the domestic market, hence squeezing our lending to the private sector. What is the effect of this on the policy measures you have taken? So that's the first batch of questions. We'll take batches as they come through. Governor.
Thank you. First question by Steve. Additional measures to reduce the cost of credit to the private sector. I think first we have to acknowledge that the cost of credit has gone down. And I think that is quite clear. Think of the lending rate. The average lending rate is at its lowest over the last, I believe, 20 years. 23 years, even more. Anyway, living memory. I hope that is clear. So, and you, by the way, the data is on our website. You can look at them. So, in that sense, we have to acknowledge that that has taken effect. As a matter of fact, Steve, you should also appreciate that the cost of lending has fallen below the levels that were there during the interest rate cap period. So I want to make the point that maybe, there has to be some, we've been vilified in terms of our statement that things, if we stay the course, we will actually end up where we want to go. It is obviously very important to get to a point where we have, which is where we are going and where we are heading, that the cost of credit is affordable and is obviously related to the correct pricing. So that is the one thing. Now, going forward, I think there are many points that we have mentioned, and we want to continue. So we will continue with the same sort of directions. And just to remind you, first on that is the whole point of ensuring that customers have good information. So transparency. So you know what is going on, meaning what are you being offered and how it relates to others. That will help you. That will help give you correct pricing. We've talked about the issue of risk-based lending. That is important. So I will borrow based on the pricing of my loan will be based on my risk, my how much risk I have in terms of my plan, not in terms of how I'm going to use the lending, meaning the riskiness of the project, etc. Also the track record. This is where the CRBs come in play. So how credit worthy am I, and so forth. All those things, and of course we have a huge. We have already begun that whole conversation about customer centricity. All these things are important. Of course, there's also the other side, which is the banks themselves need to be more efficient. And this relates, for instance, to what has been going on, which is strengthening them, strengthening their business models, and ensuring that they have practices that are much more innovative. They use more technology and things like that. So all that is going to bring the cost of credit down. But I want to say that it's not one-dimensional, Steve. It's not one-dimensional. Meaning the outcome isn't just, the outcome we want isn't just a lower, or should we say more appropriate cost of credit. No, it is also an issue of how they behave with regard to customers. So it is actually a much more multidimensional sort of outcome that we are pursuing. The question about debt collectors, all I can say is that we as a central bank do not regulate debt collectors. And they are licensed by some other entity. I don't know what's the name of the entity at this moment. What we regulate, of course, are the commercial banks, the PSPs, and also when the banks and PSPs have contracts with other entities that are significant, we also have sight of that. But whether or not a debt collector uses highly unethical maneuvers, obviously that is not something that is directly in our reach. You may also be talking about online lenders that we've talked about, the so-called credit-only online lenders, and that's a whole different kettle of fish. And that we have been discussing for a while, and we have made the point that those are entities that need to be regulated in an appropriate way, and that is something that we have embarked on that journey. Njoroge Kef is talking about a crystal ball. Yeah, absolutely. We don't have a crystal ball, and I don't know when you say that you are reading of what we are saying is that the worst is behind us. I don't know. I wouldn't be so categorical. Why? Because we have seen a lot of things that are still out there. I've talked endlessly about the SME sector. I mean, go and look at the SME sector, Njoroge. Those entities are obviously, it's hard to say that the worst is behind them. Just yesterday we had Gikomba burned down. But even others, I mean, you talk to people, you go down the road go down the bypass, you see people who are lawyers, who are accountants and all that, sort of in this hustling environment where they are selling vegetables or whatever else it is. So in terms of numbers and things like that, I don't think the numbers in the end reveal the pain that individual farmers, individual SME operators, individual old people out there that have not seen their folks, their kids or whatever, their grandkids for some time, and the way they've survived is by people sending them money by SMS, by mobile money, because nobody's going to see them. The old-fashioned way is when you visit your grandparents, you leave them some money. Now you don't do that because you're not visiting them. So I think the point I'm making here is that in one dimension, maybe what we need to say is that the expectation that we are going to sink really much farther is that has not been borne by reality or indeed the numbers. But in terms of the pain, in terms of the worst that we can see, it's still with us. And this is why we cannot, we need to make haste and deal with those specific things. Of course, there's the second issue, which is, are we out of the woods in terms of the health, the defeating this enemy, COVID-19? We know very well that we are not. And the Minister of Health has told us that many times. And so we cannot say, well, okay, we've turned the curve and everything is okay. As a matter of fact, globally, we are not. We are not out of the woods. As a matter of fact, the numbers are getting worse in the countries that opened up. So we don't want to be so bullish, I would say even foolish, as to say that the worst is behind us. I think our job is to be much more cautious. We need to be cautious. At the end of the day, it's not GDP that matters. It's the lives of people. And that is really what we should be focused on. Of course, we have business to, in terms of ensuring that the economy moves so that people can actually get their livelihood in order and get money to move on with their lives and all that. So that is important. That's why we're doing that. But we cannot be blind to the other side, because that's what that's our business as well. Then the last question about GOK borrowing. I don't know, Johnston. You're asking that your point is GOK is borrowing from the domestic market, hence squeezing. Hence, I like that. Hence squeezing our lending to the private sector. I don't know about that. When we started off the year, the borrowing by GOK, and if you want to think of domestic borrowing in terms of net domestic borrowing through T-bills and bonds, the number was 389 billion. As a matter of fact, was revised up to 409, so 20 billion, right? So 409. And today, based on the outcomes of yesterday's Treasury bill auction, they will be exactly at 409. Well, okay, change, with a bit of change, right? So 409. So I don't see any squeezing out of the private sector. This is the old-fashioned crowding out story, basically. So Johnston, I don't think there's that crowding out story. As a matter of fact, banks are highly liquid, and really they can lend, but they are not lending. That is the state of play in the thing. So I don't think the issue here is to say that GOK borrowing should be reduced so as to create more room for the lending to the private sector. On the contrary, you present the banks already have enough firepower to lend. And yes, we are starting the fiscal year next week. The new fiscal year, there'll be a target which will be publicized. As a matter of fact, it will be in the budget. So once the budget is approved and all that, then that target will be on course. But I don't think that number, as you looking at the numbers that were in the budget, it doesn't appear like that number will be an extreme number that will squeeze out the private sector. So the private sector will have ample resources. So it is your business to go out there and convince the banks, give them a proper plan, and give them your credentials in terms of risk worthiness and track record, and you'll get what you want in terms of credit. Thank you.
All right. So the second set of questions. The first one is from Kefa again. Actually, these ones are people who have asked before, Kefa and David Habling. But to begin with Kefa, this is from Radio Citizen. Headline private sector credit growth year on year remains strong. However, what has been the effective credit growth month on month from March to the present? That's from Kefa Moirore. David Herbling from Bloomberg News asks 2 questions. First one is, how much in net domestic borrowing has Kenya taken so far in the fiscal year 1920? I believe, David, that's just been answered at the tail end of the governor's last response, but if the governor wants to respond, to put an additional response, obviously he's free to do so. The second question from Herbling is, has the CBK developed the risk index that will be used by KDIC in the risk-based framework? What is the formula used in scoring banks? The last question is from Marceline Gatebi of KCB Capital, and she asks, based on the current trend of short-term papers, the 91-day Treasury bill currently below the CBR, that is a central bank rate, what do we expect in the coming days with the monetary policy actions? That last question is from Marceline Gatebi of KCB Capital. Governor?
This one will be quick. Kefa, you want the growth. I think you have them, but just to get it from me, the credit growth for private sector credit growth was at 8.1%. I think that's the number, 8.1% in the month of May, which has dipped down from 9% in April and 8.9% in March. Obviously, this has come up from where it was, even in the 2% range. So, Kefa, this has been growing, and you've been watching this over the last, I guess, over the last 2 years. So I'll leave that. But I think the point again is that credit growth is constrained in many ways by the environment, the economic environment that we are in. So in that sense, it is important to appreciate that it is 8% in a very hostile environment for lending. So I leave that. CBK developed a risk index. This is from Herbling. That will be used by KDIC. David, I answered this question last time. So I told you when we are ready, we'll let you know. So I don't think I want to anticipate things. So no need to ask a hypothetical question. When things are ready to be revealed, they will be revealed. Then the next one is about net domestic borrowing. I already answered this question just now at 409. That is the number which should be the final number for this fiscal year, and the target was 409, so we ended up smack on the target. If you want more on that, you have it on our website. What else? Marceline asked the question. You see, Marcy, this was just one auction where the rate fell below, or just below, say, the CBR. I hope you understand that we don't have point projections. You are working for a capital firm, so you should know this. It's not a point target, kind of thing. Things happen in the market which have nothing to do with or have little to do with the other factors. I mean, if Marcy, you put in your bid at 6%, sure, the bid will be accepted, and you have your reason for the 6. Maybe you have other issues, other factors that you are dealing with. So it is a bit. I mean, I find it a bit excessive if we actually think that there's only one reason to to invest, which is the return. It doesn't work that way, and you know that. There are other reasons. You can use T-bills for many other things, and so maybe you had to do that, and therefore you put in a low bid because you really wanted to be sure that you're getting that specific investment. So what point am I making? I'm making the point that the yield curve is not a sort of a very thin line all through. And numbers change from one auction to another, but it remains somewhat, let's say, in that particular area, meaning it remains invariant, even as it moves a little bit from one auction to the other. So I don't think we should put too much weight in a particular movement, because there are many other factors that drive the bids and indeed that drive the shape of the yield curve. I think I've answered those questions.
I believe so. So we'll now take the third set. This looks like the penultimate set, going by what we're seeing coming through on the platforms. So I'll begin with a third set with Otiato Guguyu of the Business Daily. Otiato asks, the waiver on transactions has affected 80% of transactions. I believe, Otiato, you're asking about the mobile transactions. How is CBK addressing the concerns of the business foregoing 80% of their revenue? That is a manner in which Otiato asks his question. Mbithe Mwema from Metropole TV is asking, will CBK continue to issue T-bills, that's treasury bills, to fund government operations, or will T-bonds or treasury bonds take over as a sole source of funding for the domestic market or from the domestic market? That is Mbithe. Collins Washira, this is interesting because Collins says he's just a normal citizen, not representing any media house, but we'll take the question anyway. On the personal level, are savings going up with individuals, and is that a good thing at this moment in time? Or does the Central Bank of Kenya prefer people spending? There's another set of questions. I'll leave those three, Governor, from Otiato, Collins, and Mbithe. We'll take the last one in the last set from David Njoroge and from Charles Moniki.
Okay, so we begin with Gugujus. All I'll say is the central bank reviewed the emergency measures that were put in place and came out with the determination that we said. I have seen all sorts of articles that Business Daily has put out, and all I can say is we are not in the business of, let's say, having public discourses about some of these things. The next question, well, I'll take it from the top, okay? So, Mbithe, will CBK continue to issue T-bills to fund government operations, or will T-bonds take over? The point here, Mbithe, is that the T-bills are very important, and sure, they'll always be there. They'll always be there. So what had happened is that there was a huge, let's say, increase in the share of T-bills was rather high. And therefore, as a matter of policy, we needed to reduce the share of T-bills and bonds, really increase the average time to maturity of the overall portfolio. And I think the numbers are clear that that is what has happened. And I think it was one of the successes of this fiscal year. If there's anything in terms of government borrowing that you can point out in terms of successes, one is this one of lengthening the average time to maturity. That was important, and it has allowed everybody investors and government alike, to actually benefit from that. T-bills will always be there, and T-bills are supposed to be more smoothing instruments when there's a shortfall of revenues, rather than using them for, let's say, raising funds for building some infrastructure thing or some other expenditures. That is not the appropriate use of T-bills. But again, the point I'm making is they'll always be there. They'll always be there, and that's, well, so that's clear. Colin asked a question. Colin, two things here I want to say. Actually, in the month of April, if you looked at deposits, deposits actually went up. And I'm thinking also, for instance, in your mobile wallets. For most people that maybe don't have that much, let's say, savings plan, they use the mobile wallet. And so actually, as their transactions decreased, meaning because of the uncertainties that were there, they saved. You may call those forced savings, or in our jargon, we'd call it precautionary savings, right? So those are precautionary. So from your perspective, I think you need to think more long-term. Colin, you need to save, but begin thinking long-term. So don't save just for tomorrow. You also need to have, I mean, when tomorrow, I mean literally tomorrow. You need to have a plan that you are saving, let's say, into next year, to have a specific target. Let's say you're saving for your education, or you're saving for a specific buying a house, or some other element like that. And also you want to have that sort of savings for, you know, things that may happen, you know, in terms of you don't know, you may get sick, or your family may need some sort of quick expenditure, emergency expenditure, and that would generally come out of some of your savings. So I think the point here, Colin, is that we need to have a sort of a holistic view. If there's something we do poorly as Kenyans, is savings. I think there's a lot of, I'll put it, you know, sort of decisions on the fly and not long-term thinking. And therefore, you get to 5 years, and somebody, after they've been around their first job, they've been 5 years at the job, and there isn't much that they can say that they actually got out of that job. Everything was consumed. Or maybe some of the things were large, should we say, consumer durables, you know, whatever those are. Well, one needs to save for other matters, and you need to begin now. You need to begin now when you're young, and end up with a proper plan that covers the various aspects of your life. Was that it?
That, I believe, was it, Governor. So the last set of questions, we'll just throw in, I think there are 5, just to finish up. We shall begin with David Njoroge of Saiton Investments. David is asking, is monetary policy transmission still feasible? And in addition to that question is, would further cuts translate to improve private sector credit growth with the current high credit risk levels? That is David. Charles Moniki of the Business Daily is asking, out of the extra 30.8 billion shillings in released liquidity that banks have lent in COVID support, how much of that has gone to SMEs? Betty Kiptum of KBC is asking, how feasible is the external borrowing target set in the 2020-2021 budget based on the current global economic recession, and how accessible will the funds be? Julio Wino of Capital FM, Governor, could you comment and advise on this discussion on a loan restructuring? Are mobile loans included in the basket? If not, what should borrowers expect? The last one, I think, let's just wind up with our friend David Herbling, who asks, where do you see fiscal deficit in this fiscal year 1920, given revenue underperformance due to the virus?
Okay, fine. Beginning from the top, as I said, well, let's begin from the specific answer. Monetary policy transmission, which is what he's asking, but I guess he's asking whether efficacy of monetary policy. Do we see that as something that remains? And the answer is yes. Maybe not through the channels that are the standard channels, but other channels as well. So yes, monetary policy remains efficacious. And again, as you have seen, there has been, the economy has been buoyed, meaning kept up, through a lot of, I would say, the monetary policies that were put in place. So I think the quick answer with that is yes, it remains efficacious. So monetary policy remains efficacious. However, I guess the point he was asking, the way he's asking it, he's asking about interest rate cuts, whether we can continue with interest rate cuts going forward and so forth. And I think the point here is interest rates, and I answered this question, I think, last month, in a different way. This was the question this was the first question, actually, from last month. And the question there related to interest rates. Can we continue, is there scope for further cuts in interest rates? And my point is, it isn't just interest rates, it's actually a package. We did some work on the CRR, for instance, and that has been very efficacious. We also have done a lot of work on the repo, for instance, extending the repo to 90 days, right, from 28 days. There have also been other measures that we have discussed before. So taken as a package, taking all this as a package, this is all the scope or the remit of monetary policy, and it remains efficacious. The issue isn't just having a number, private sector growth going up from 8.1 to 9. That is not the only thing that matters. And I think I explained that earlier before. The point also is you mentioned the risks. And those risks are there, and we have to deal with them appropriately. It means the lenders, the banks, need to understand the risk and be ready and willing to measure them and deal with them. So in a sense, not walking away just because a customer has a certain level of risk or whatever. They need to deal with that. For instance, one of the things we've been talking a lot about is the SMEs. I go back to the SMEs. And it isn't just credit that matters. One of the key elements about SMEs in order for them to survive is having let's say, orders. So, and some of the SMEs, let's say tailors and things like that, are making masks. The masks that we are wearing now, and that is useful. So it isn't just credit. There is the other component. As a matter of fact, as you know, one of the things that is clear in this crisis is the supply chains that have been disrupted. So it isn't credit that is going to fix the supply chains. It is actually other work that needs to be addressed directly at the supply chains. So efficacy of monetary policy, yes, taken together, but also let's not really focus on monetary policy on its own. And this is why we need to look at other factors like fiscal, all the other measures that the government has put in place to strengthen the economy. Now, Mwaniki Charles is asking about the money that was released from the CRR, or the reduction in the CRR, and how much of that has actually gone to SMEs. I don't have that breakdown. I cannot tell you now. As I said, we have it, but I don't have it here to quote it for you. How feasible is the external? The external borrowing target that is there, as you know, this is now an issue of how the budget is put together. And when they put together the external borrowing target, also the domestic borrowing target, it's not just a number that is put in there, okay? Actually, behind it, there are loan by loan sort of considerations. So in that sense, yes, it is feasible because you can actually go behind it and see, okay, which company, or rather which lender is going to provide X amount and so forth. And I think the issue here, as you know, is not so much the target that is a problem. The issue quite often is the difficulty in concluding whatever needs to be concluded in order to provide those resources. At times it's on our side, meaning Kenyan side. At times it's on the borrower's, on the lender's side. So this is a complex sort of issue, but I think there is an entire office in the National Treasury that is charged with following up and following through on those commitments. Now, in terms of mobile loans, again, talk to your banker. Talk to your banker. Talk to your banker. This has to be the mantra that really we need to follow. Talk to them, they'll tell you. So I think for me, it's not so much what borrowers need to expect. You talk to your banker. You borrowed from the banker. So have that conversation with them It is much more important for you to go there and have that face-to-face conversation. And then finally, the fiscal deficit I think it is in the National Treasury numbers. It's on the website. If you listen to the minister's presentation in Parliament, he did make the point that they have revised their revenue expectations for the year, precisely because of the underperformance that they are seeing, obviously related to the COVID-19 situation. So I think the numbers are clear, and you can go to the National Treasury's website. You'll see both the numbers that were presented in Parliament. Also, there has been a supplementary budget 3, that is either been approved today or next week. It's a matter of days. That also is, those are public documents as well. You can look at the numbers there.
All right, thank you very much. That was the last set of questions for this press conference. You have been watching and listening to the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge, in the Post-Monetary Policy Committee press conference for the month of June 2020. As was announced in yesterday's press release from the MPC shall be meeting again in the month of July, and as is usual, we shall let you know of the date through our website and other channels, and there shall be another post-MPC press conference the day after that MPC meeting is held. But for now, thank you very much for joining us. That shall be it for now, but see you again next month.